For years ago, the US government shut down a platform that was predicting the future with scary accuracy. They fined it $1.4 million, banned every American from using it. The reason? It was too good at what it did. That platform was Polymarket, and 3 weeks ago it came back. But here's what nobody is talking about. While Polymarket was banned, Wall Street was watching. And what they saw terrified them. Because this wasn't just another crypto gambling site. This was something that could replace Bloomberg terminals, polling data, and Vegas bookmakers all at once. Right now, DraftKings, FanDuel, Robinhood, even the New York Stock Exchange are in an all-out war to control what analysts are calling the next trillion-dollar market. And the data is already in. Polymarket retains users better than 85% of all crypto platforms. Translation: people aren't just trying this once. They're coming back every single day. But here's the part nobody is connecting yet. So what exactly is Polymarket? On the surface, it's simple. You bet on real-world events. Will Bitcoin hit $100,000 by year-end? Will there be a recession in 2026? Who wins the Super Bowl? You buy yes or no shares that cost anywhere from 1 cent to 99 cents. If you're right, each share pays out exactly $1. Unlike traditional betting, where you're playing against the house, Polymarket is a marketplace. You're trading with other people, just like the stock market. Except instead of trading shares of Apple or Tesla, you're trading the probability of future events. Here's the official story. Polymarket operates on blockchain technology using a cryptocurrency called USDC, which is pegged 1-to-1 with the US dollar. Every transaction is transparent. Every trade is recorded. And because it runs on the Polygon blockchain, there are essentially no transaction fees. The mainstream media will tell you this is the democratization of prediction. That anyone can now participate in forecasting the future. CNN, Bloomberg, even the New York Times started citing Polymarket odds during the 2024 election because the platform accurately predicted outcomes better than traditional polls. In November 2024 alone, over $3.2 billion traded on the U.S. presidential election on Polymarket. That's more money than most small countries have in their entire treasury. The company just got approved by the CFTC in September 2025 to operate legally in all 50 states after being shut down in January 2022. CEO Shane Copland says they're no longer banned and ready for mainstream adoption. Intercontinental Exchange, the company that owns the New York Stock Exchange, just invested up to $2 billion into Polymarket at a valuation approaching $11 billion. Wall Street is betting billions that prediction markets are the future. That is the official story. But if you look at what's happening behind the scenes, the math stops adding up. Let me show you the numbers they don't want you to see. According to data from Dune Analytics, Polymarket has higher user retention than 85% of the 275 crypto platforms they tracked. That includes major exchanges like Coinbase and decentralized finance protocols managing billions. Most crypto apps lose users within weeks. People sign up during hype cycles, make a few trades, then never come back. But Polymarket? Users keep returning month after month. Why? Because prediction markets are event-driven. There's always a new election, always a new sports game, always breaking news. Traditional crypto trading requires you to watch charts and guess when prices will move. Polymarket just asks, what do you think will happen? Now here's where it gets interesting. Robinhood CEO Vlad Tenev said something on CNBC last week that sent shockwaves through Wall Street. He said, quote, "We think we're in the early stages of a prediction market supercycle." A supercycle. That's a term you only use when you think something is about to explode exponentially. And he's not alone. Research firm Eilers & Krasik just released a report projecting that prediction markets could hit $1 trillion in annual trading volume by 2030. $1 trillion. To put that in perspective, that would make prediction markets bigger than the entire global gold trading market. Let that sink in. But here's the part that should terrify traditional sportsbooks. Prediction markets are already legal in all 50 states. Sports betting, only 31 states. Polymarket and platforms like Kalshire can operate nationwide because they're classified as derivatives, not gambling. This is where the math stops adding up. If prediction markets can legally operate everywhere, why would anyone use traditional sports books that have worse odds, higher fees, and geographic restrictions? The answer is they won't. And Wall Street knows it. That's why DraftKings and FanDuel both just launched their own prediction platforms this month. That's why Robinhood expanded into NFL parlays and prop bets. That's why Fanatics partnered with Crypto.com. That's why every major player is scrambling to build prediction market features before they become irrelevant. But there's a darker side to this story. The American Gaming Association, which represents land-based casinos, is waging war against prediction markets. They've launched campaigns claiming these platforms skirt regulatory intent. DraftKings, FanDuel, and Fanatics all quit the American Gaming Association over this exact dispute. Translation: the old gambling establishment sees prediction markets as an existential threat. And they should. Because according to the Eilers and Krasik analysis, mature prediction markets could support trading volumes equivalent to 60% to 80% of today's entire online sports betting market. Except prediction markets can operate nationwide with lower costs and better user experience. To understand why this is happening, we have to look at 2008. After the 2008 financial crisis, something changed in how Americans think about risk. Millennials and Gen Z grew up watching their parents lose everything in the housing market collapse. They watched banks get bailed out while regular families lost their homes. They stopped trusting traditional financial institutions. Enter crypto. Bitcoin was created in 2009 as a direct response to the financial crisis. The first block on the Bitcoin blockchain contains a reference to bank bailouts. It was a middle finger to the system. But here's what nobody connects: prediction markets are the natural evolution of that same anti-establishment movement. Why should you trust polling companies that got the last 3 major elections wrong? Why should you trust analysts who said the housing market was fine right before it collapsed? Why should you trust bookmakers in Vegas who set odds based on protecting their own profit margins? Prediction markets say, trust the crowd. Trust the wisdom of thousands of people putting real money where their mouth is. And the data proves they're right. This is the smoking gun everyone is missing. Prediction markets aren't just gambling. They're information aggregation systems. They're crowdsourced intelligence. They're what happens when you give thousands of motivated people financial incentives to be right. Research shows prediction markets can be more accurate than expert forecasts because they eliminate individual bias. When you have to risk actual money on your prediction, you think differently than when you're just sharing an opinion. Now, here's the trillion-dollar question. If prediction markets are more accurate than polls, more transparent than Wall Street analysts, and more accessible than traditional derivatives markets, what happens when institutions start using them? The answer is already happening. Citizens Bank released analysis showing prediction markets are in the early innings of exponential scaling as the asset class transitions from speculation to a more mature component of capital markets, with institutions likely coming next. Translation: the smart money is coming. Hedge funds, investment banks, pension funds. If you think this is big now, wait until you see what's happening behind closed doors. So, what does this all mean for you? 3 key takeaways. First, prediction markets are not a fad. When the New York Stock Exchange parent company invests $2 billion and Robinhood's CEO talks about supercycles, this is real. The trillion-dollar projection isn't hype, it's math based on current growth trajectories. Second, the convergence of gambling and investing is accelerating. Robinhood lets you trade stocks and NFL props in the same app. The lines are blurring, and regulators are struggling to keep up. This creates both opportunity and risk. Third, and this is critical, user retention data shows prediction markets create habitual behavior. They're designed to keep you coming back. Every news cycle becomes a trading opportunity. Every election, every game, every earnings report. The platforms that win this war won't just be betting sites or trading platforms. They'll be the new information infrastructure for how we collectively forecast the future. Is Polymarket's US comeback the beginning of a financial revolution? Or are we watching gambling dressed up as innovation? The answer is probably both. What's undeniable is this: a market that didn't exist 5 years ago is on track to hit $1 trillion by decade's end. And every major player from Wall Street to Silicon Valley to Las Vegas is fighting for their piece. Disclaimer: I'm not a financial advisor. This is analysis based on publicly available information. Do your own research before making any financial decisions. If you think the Polymarket story is wild, you need to see what's happening with Kalsher and the CFTC investigations that nobody is talking about. And if you want to stay ahead of the biggest shifts in markets, subscribe. Because the convergence of crypto, betting, and Wall Street is just getting started. The future might not be predictable, but you can bet on it.